Welcome to a brand new explainer. Today, we're diving straight into one of the most fascinating financial stories in the market right now. You know, when most people think of AT&T, they picture this somewhat boring legacy telecom giant. Maybe it's literally the company your grandparents used for a landline. But as we're going to see, there is a massive, massive cash engine hiding beneath that dusty reputation. So we're going to unpack this whole AT&T financial paradox to find out, is this company just a high-yield trap, or is it actually a hidden gem hiding in plain sight?
Okay, let's just jump right into this first number because it is an absolute jaw-dropper. In the second quarter of 2026, AT&T generated a staggering $4.7 billion in free cash flow. To put that insane scale into perspective, that is roughly $51 million in pure cash being pumped out by this business every single day of the quarter. That's up from $4.4 billion in the exact same quarter the year prior, which is roughly a 6.3% growth rate year over year. We are literally talking about billions of dollars in pure, unadulterated cash generation. But actually, the story gets even better when you look at their earnings. At the exact same time that cash flow was surging, their adjusted earnings per share jumped from 54 cents to 65 cents. That translates to an incredible 20.4% growth rate. And how did they pull that off? Well, mostly through ruthless cost-cutting, streamlining their operations, and basically just focusing strictly on what they do best. The result is the kind of bottom-line explosion you typically expect to see from some nimble tech startup, definitely not a decades-old telecom company.
Which brings us to the central mystery of this explainer. With financial momentum that sounds remarkably like a Silicon Valley darling, double-digit earnings growth, rapidly expanding cash flows, we really have to ask, why is a company with tech-like growth still priced and treated by the broader market like a slow-moving, sleepy utility? What exactly is keeping this stock so grounded, and why are investors still so hesitant to jump on board?
Well, to understand the market's hesitation, you gotta look at how investors currently view the stock. Most people are initially lured in by the company's dividend yield, which is sitting at roughly 4.4% right now. They pay out 27.75 cents every quarter, equaling $1.11 per share annually. Now, for income-focused investors, a 4.4% yield is immediately attractive, right? But there's a catch. When a stock price plummets, its dividend yield artificially spikes. Chasing that high percentage can be incredibly dangerous if the underlying business is actually shrinking, basically leaving you holding the bag. It's what we call a yield trap.
So to figure out if that 4.4% dividend is a trap, we have to look past standard revenue metrics and focus closely on free cash flow. Free cash flow isn't just money coming in the door. It's the actual cash left over after the company pays for all the heavy capital expenditures required to maintain or expand its massive network. A high yield backed by organically growing free cash flow, that is a beautiful thing because it means the dividend is actually sustainable. But a high yield without it, that's essentially a kicking time bomb.
What's really fascinating here is how comfortable AT&T's dividend actually looks right now. When you map that $1.11 annual dividend against their expected 2026 midpoint adjusted earnings per share of $2.30, you'll see it only consumes a very manageable 48% payout ratio. So why does this matter to you? Because a lower payout ratio means safety. It means AT&T is generating significantly more in earnings than it needs to cover those dividend checks, leaving a really nice buffer of retained earnings to protect investors if we hit an economic downturn.
And when we map out their wider strategy, management is officially targeting at least $18 billion in total free cash flow for the full year of 2026. If they hit that mark, they're creating a substantial, multi-billion-dollar pool of cash. Not only does this comfortably protect that dividend we just talked about, but it gives them a massive war chest to maneuver with. They can use that excess cash to actively reward shareholders through stock repurchases, or just pay down obligations without even breaking a sweat.
Now, this cash engine exists today because AT&T made some incredibly hard, humbling choices over the last few years. The legacy AT&T was totally bogged down by non-core operations. You might remember, they famously dumped tens of billions of dollars into disastrous, scattered media acquisitions like Time Warner and DirecTV. But the 2026 version of AT&T, it is radically simplified. They finally admitted defeat, sold off those distractions, and aggressively refocused entirely on their core historical strengths, providing wireless communication and incredibly fast fiber connectivity.
And you know what? The data shows the strategic pivot back to their roots is absolutely working. Their advanced connectivity segment, which bundles fiber, fixed wireless, and postpaid wireless, reported a very solid 5.1% service revenue growth in Q2. The strategy is honestly brilliant in its simplicity. Think about your own life for a second. If your phone plan and your home internet are tied together through the exact same provider, you are way less likely to go through the massive headache of switching to a competitor. That combined customer relationship just becomes exponentially more valuable.
Furthermore, they're keeping those new fiber and wireless customers fiercely loyal. Right now, they're boasting a remarkably low postpaid phone churn rate of just 0.86%. That means fewer than 1 in 100 customers are leaving each month. In the cutthroat telecom world, where acquiring a brand new customer costs an absolute fortune in marketing and phone subsidies, keeping churn under 1% is basically the holy grail. By holding on to these subscribers so effectively, AT&T drastically improves the underlying economics and profitability of its entire business.
So, the crucial point here is that this company has great cash flow, a safe dividend, and deeply loyal customers. But before you buy into the hype, here is the massive elephant in the room that dividend seekers absolutely cannot ignore. AT&T carries a suffocating $126.4 billion in net debt, with their total debt reaching $144 billion. To put that massive anchor into perspective, their net debt is roughly the size of the entire gross domestic product of a country like Morocco. That astronomical mountain of debt is the exact reason the stock isn't flying high right now.
That staggering debt load exists because telecom requires unbelievable capital intensity. To generate that $4.7 billion in free cash flow during Q2, AT&T had to pour out $6.1 billion in total capital investment. Think of it as the ultimate telecom treadmill. They constantly have to spend billions laying miles of physical fiber optic cables and continuously upgrading cell towers just to maintain the network that creates their cash in the first place. It's an incredibly expensive treadmill to run on, and stepping off just isn't an option. So when you stack these risks together, a very clear bear case emerges. You've got that breathtaking mountain of $126.4 billion in net debt, the punishing $6.1 billion in quarterly capital requirements just to keep the lights on, and, of course, bloodthirsty competition from well-funded rivals like Verizon and T-Mobile. Plus, while that $1.11 dividend is relatively safe, investors really shouldn't expect explosive dividend hikes anytime soon, simply because every spare dollar of cash is desperately needed elsewhere to service that debt.
Oh, and there's also a completely new, looming technological threat that we have to discuss: SpaceX's Starlink. Will a massive network of expensive cell towers soon be entirely obsolete? Investors are legitimately questioning if satellite connectivity beaming straight from space will eventually bypass and disrupt traditional 5G and fiber networks altogether. Now, to be fair, there are still significant technical, regulatory, and commercial hurdles for satellite networks, and AT&T's terrestrial bundle is currently very strong, so an immediate collapse isn't likely, but it's a very real existential risk worth monitoring closely over the next decade for sure.
So, with all that in mind, how does AT&T stack up against its biggest traditional rival? When you compare AT&T directly to Verizon, it becomes super clear that investors have a distinct choice to make. Yes, Verizon currently dangles a juicier, noticeably higher 5.7% dividend yield compared to AT&T's 4.4%. But beneath the surface, AT&T is quietly pulling away with a superior 6.3% cash flow growth and that explosive 20.4% earnings growth. It really forces you to ask, do you want the highest immediate yield or the company that's growing its cash flow far more reliably?
When you cut through all the noise, the true AT&T investment thesis for 2026 becomes crystal clear. It isn't about rapid, exciting dividend hikes, and it's definitely not about becoming the next flashy tech stock. It's simply about execution. The ultimate goal is to consistently generate that $18 billion plus in cash flow, use it to aggressively deleverage and pay down that enormous balance sheet, continue capturing those loyal fiber and wireless customers, and comfortably maintain that stable 1.11 payout while they do all the heavy lifting in the background.
Which leaves us with the ultimate paradox to watch for the rest of the year. AT&T has successfully reinvented itself into a streamlined cash machine, but it's dragging a historic, country-sized amount of debt behind it. So I'll leave you with this final thought. Will the market finally wake up and reward AT&T's phenomenal cash engine, or is $126 billion in debt going to keep this stock grounded forever? Think about that as you review the numbers, and thank you so much for joining me on this explainer.